Hello, everybody. Welcome to the Coach's Playbook for all you YouTube folks out there. It's Tuesday, July 13th. We're back after a week off. Hogue was on the boat. Dan, where the hell were you?
I was pretty much on the boat.
Okay,
I
everyone was
was
on.
I just took a little staycation.
Oh, man. Meanwhile, I was here, you writing emails and doing the whole thing. Anyway, welcome to the Coach's Playbook. Today, we're talking about the history of market corrections and perhaps the future. Won't give too much away because damn if I know. But first, before we get started, Mick, I hear you have a primetime trader shout out for us today.
Yeah, really happy about this one. Jibin Huang up about $7,200 trading the NASDAQ today. So doing a great job.
That is
Yeah,
awesome.
he's gonna be going to space soon with those numbers.
Right.
I guess that's what you do now when you got a bunch of money.
That was pretty cool. I watched those videos of Richard Branson up there.
Yeah, I'd like to do it at some point. Right now, I mean, if it were like 14 million, maybe I'd do it. But 28 is just, too much money for me.
A little rich.
My
Yeah.
pockets aren't that deep.
Yeah, but we'll see what happens. So today we're talking corrections, and we want to go over some historical data. We get some great stats. Dan claims to have some great stats. We'll see how they shake out here. But first, and I regret not looking into something before we came on, although we all are probably somewhat familiar what a market correction is. Does anybody have the definition of a market correction? I believe that maybe it's more than a 5% pullback, or there's a 10% pullback, I believe, is the official. Oh, Dan?
The
Enlighten
official,
us.
the official is a 10%, or we'll just read it verbatim. In investing, a correction is a decline of 10% or more of a price of a security from its most recent peak. Corrections can happen to individual assets like an individual stock or bond, or to an index measuring a group of assets.
Yes, and since a lot of you out there are trading those indices, you've noticed that there's been a lot of recent highs in those market lately. Besides the brief explosion of volatility on Thursday last week, which has receded, it's been a pretty constant grind higher, and that's kind of how it works. But as Hogue always says, the market always looks best at the top and worst at the bottom. So always got to be ready for these things. So I thought today we can go over it. Hogue, do you want to say anything about corrections before I dive into some of these numbers here?
A lot of this missing hair up here is due to some of the market corrections that I've personally been through. I was a clerk in the S&P pits in 1987 when that fell apart, and I don't think anybody had ever seen anything like it. Back then the S&Ps traded in nickels, like the E-mini S&Ps trades in quarters. The big S&P, this was before the E-mini S&Ps, traded in nickels. So there were 20 ticks per handle or per point, and each point was $500. So for many years, the bid offer was one nickel. It was 10, 15, 15, 20, 20, 25, 20, 25. During the crash, we had bids and offers that were sometimes 10 points apart. So we're looking at 200 ticks difference between the bid and the offer. I don't know how we did it. I don't know how anybody didn't lose a lot of money. A lot of people made a lot of money, but it was a kind of a surreal experience. I was only a clerk. I had no risk, but I certainly was maintaining a lot of risk for the people that I was working for. And I just remember it being 4 days of no sleep, because it started on Friday, and then Saturday and Sunday, everybody was still going to the exchange to try and reconcile any out trades. And then Monday it started and continued its move to the downside. Now, there was a economist by the name of Prechter that I had heard through the grapevine on Friday, that he said that this was going to continue into and through Monday. So I told a trader that I knew, who kind of overheard me say it to somebody. I said, I don't want to say anything, but she was like, no, you have to tell me. So I said, well, I understand Proctor is saying that this move, which started on Friday, is going to continue through Monday. So I found out later she held a position all weekend. She was short a few and had a big day on Monday. So it always seems as though when it happens, it seems like a surprise to everybody. I think it's, it only happens when everybody's all into the upside and there's nobody left to buy it. So it just starts with a small fire and just snowballs on its way down.
Right. You need to shake people out. You need people getting levered up. There's a lot of ingredients to go into the pot there. And what Hoag's describing in 1987, I believe the market dropped 20% in one day.
Yeah.
An S&P. So just to give you an idea from your risk management perspective out there, is you hear a lot of things about normal distributions in trading. There's also a phenomenon called kurtosis. The tails are really wide when you're trading, right? When you're building your risk models, I think I've seen somewhere that if the market returns were normally distributed, that the odds of that crash in 87 would be like the odds of picking a single oxygen molecule out of the atmosphere or something that would never happen, right? It's a herd mentality. Things get weird, especially when the market's going down. So let me start with a few stats here. I'm taking this from our good friends at Guggenheim Investments. All right. Since 1945. All right. We're starting after World War II here. The number of declines in the market from a peak that were between 5 and 10%, it's happened 84 times. The average decline was 7. It usually took about a month and just a month to recover. If you go to 10 to 20% pullback, that has happened 29 times since 1945. And the average time to recover was 4 months. 20 to 40% in the market happened 9 times and took 14 months to recover. And 40 plus has happened 3 times and took 58 months to recover. So what we see there is that it starts growing. The recovery time gets a little bit more exponential as you see these bigger and bigger drops, which we talk about a lot when if you lose 50% of your account, you got to get 100% of it to get back to where you were. So a lot of people think, myself included, that a certain number of pullbacks is healthy because it kind of avoids those big drop-offs. Sorry, everyone just froze there for a second.
I think you froze for us.
Oh, did you get all my stats?
We got your
everything.
stats.
Yes, we did.
All right. So we're talking about the health of correction. So many people out there believe it's not healthy when you have a market such as we have now, where you don't get any sort of pullbacks or relief. So we don't really know what the fair value of things if no one ever comes in and sells it. So that's just kind of my thoughts on it. Dan, I understand you have some information you'd like to chuck out there as well.
Absolutely. Mine's a little bit different, but 1980 to 2018, the S&P had 37 corrections with an average fall of 15.6%. As of 2018, the S&P's average correction in its lifespan was 13% and averaged about 4 months to recover that. So slightly similar to some of the stuff Jack has. I've got some of the same exact ones as Jack, so I won't dive into that. But I think it's important, though. John brings up the 1987, the crash of 87. We've all heard about that. We've all heard the stories. We've seen the documentaries. I have heard crazy things from that time. I've heard guys that were stockbrokers that were told, don't answer your phones, shut the phones. You're not picking them up. I mean, I've heard some crazy things that happened. And I think there's a huge change that we're seeing now. If we go back just in the last 2 or 3 years, we've seen some crazy days happen. 2018, December 23rd, I think. We had that 2-day break where it fell into correction territory. We saw it a lot, last year, 2020, holy cats. We fell, 12% in 8 days or something like that, pretty fast.
And overall, it was about 30 to 35% that pullback.
It just kept going. It kept going. We went from, correction to bear market territory in just a couple months. And then I think something that we need to note as traders is the difference in what's actually happening, right? In 87, it was human to human contact. It was me yelling at John, I'm selling, John saying I'll buy him. Whereas now there's not human contact. There's also just AI involved, right? We have these HFTs, you have computer systems that are designed to trade on a trending higher market. The second something overpowers that market and ignites the sell-off. There's a little switch on every computer. You just flip that switch, you shut it off, and you wait till someone catches it. And that's what we're going to see happen. I think it's, it's pending, it's looming. It'll go with my quote here today. But I do feel, you see it right now. You look at the NASDAQ, you look at S&Ps, like it's a straight line up right now. Well, not straight line, but a nice hockey stick going, lower left to top right.
Northeast.
With very, very minimal down days. I think we saw one last week. A little bit of a sell-off. Maybe, part of me started thinking, oh, it's coming. No, not yet. Not yet. Normally I'm, the eternal bull. But yet I'm starting to think bear is around the corner. When that could be tomorrow. It could be 5 years from now.
Yeah. And you also have to, it gets a little bit, and why being a bear is so hard and not recommended in the long term is, for all we know, it could be, a couple months from now, we could rally 10% and then fall 10%. It'll be like correction, but we'll still be where we are now. Right.
Right.
One last stat I wanted to share, just to emphasize how bad things theoretically could get, is anyone want to take a guess of what percent the market fell during the Great Depression from the peak to the low?
72%.
Higher.
84%.
Higher.
I don't even want to look higher.
89%. And that would, I looked it up, that would be equivalent of the S&P 500 going from where it is now at about 4380 to 481. So that would be very spicy. I don't think that's not what I'm calling for, but to give you an idea of how bad things got then. But, not that crazy, because it was just, in 2008, 2009, it got down to, what was the low? 666 or somewhere around there. I always remember it being around
that
the
was
devil's
it.
number.
That was 666.
Do you think that that had to be kind of like a lot of people just got it there, like, it's not, this is a sign, an omen? But yes, hopefully we don't see anything that extreme as a breakdown, but we do see a lot of, has anybody out there, and this is a question for everybody watching online, but yourself, anybody that owns a place, go check out the Zillow Zestimate, even if the place isn't for sale, on your place. And I did it for mine the other day, and in the last month, according to Zillow, my condo has appreciated like 19%. I don't think I'd ever actually be able to sell it for that. But to me, that's just sort of, everything's just kind of frothy at this point.
Yeah, I just I have Zillow up on my computer. I just looked at mine. I wouldn't mind selling my house for that.
Right. And when a lot of people do that once, not great.
I'll be going on Zillow after this video.
Yeah. Yeah, you're going to see. By the way, this will be the last Coach's Playbook before we all sell our places. And
right, I'll
be having my hot pockets surfing the web.
Yeah, exactly. So what Dan said, I think, is important about, or what you guys mentioned, the idea of not kind of, preparing yourself and not kind of catching falling knives and those things. I think it was Dan talking about the HFTs. So Hoger, Mick, do you have anything you want to talk about, like trading those sorts of reversals, or what has worked in corrections past?
Sure.
Yeah,
I could take it away unless John wants to go.
Go for it, Mick.
Okay. So, I mean, there's corrections and then there's crashes. I know we've talked a little bit about both of them. I do think corrections are healthy. There's a lot to say about corrections. A lot of it has to do with human emotions. We also have to make a separation between speculating and investing on a longer term. When you talk about corrections and crashes, that's usually from, new market highs and whatever that derivative is that you're talking about. We know that, and I've been hearing this for 20 years, markets tend to fall faster than they rally. In general, not always the case, but, when you have a market that's grinding higher and, you've got two kinds of investors or speculators there. There's people that, have been riding it up and slowly adding. They might have a nice core position at a lower price and they're in the money. You also have people that are, new entrants to the market, buying highs, which is always something that's, pretty high risk. I like the idea of following a trend. So if you're in a bull market, you should be buying. But if you're the one that's, marking up the new prices, you have a lot of risk there. So what I'm getting at with that is, you have new entrants into the markets that kind of have weak hands, and can get shaken out. And when that happens, people start chasing each other to puke their positions, get out of the losing positions. We're in a day and age now too, where information flows so freely and quickly that, and in our human nature, we like bad news and hearing about bad things. So that news spreads quickly. And when it comes to emotions, you have fear. So people start to, hear bad things, they start dogpiling out, and it's a snowball effect. So, we've seen that. And as far as trading corrections or, trading crashes, I think it's a difficult thing to, you don't want to catch falling knives. If you are going to be buying something that's going down, you don't need to put your full position on. You can add in a little bit. I think that's where you really need to separate like trading equities versus trading leveraged futures products. I know for myself personally, when COVID happened and we had the huge market sell off, it was uncomfortable watching, assets that I had, lose, my returns were getting shaved pretty nicely. And it was, in your gut, and it's smart to buy dips. But it's really tough to do, something you might have had big return in. It provided good opportunity to add into, these companies if you believed in the companies, but it's also very hard because, me personally, I'm like, I know this is the right thing to do, but it's just so uncomfortable. Do I put a half a unit on, a half a position on here and watch it continue to go? Do I put, a full position on here? So it's really, really tricky stuff. I see so many, as far as futures trading goes, I see a lot of traders struggling in these grinding bull markets. But I also think there's so many people that, we heard about it back in 2008 with the housing crisis. We heard about it when COVID hit. People are always hunting for the markets to turn over and crash. And, those people, they've got to time things so well that a lot of them just get cut to pieces, having that stance on the way up.
Yeah, it's much less cost efficient to be, there's no way that's as cheap to short the market as it is to buy it, right? You either got to buy puts or you got to borrow on margin. There's not a real easy way to do that. So that's sort of the bull bias as well. What I wanted to throw in there, Mick, is it comes down to like the trader psychology individually. The market's made up of participants. And even though we preach objectivity and we'd like to be just unfeeling people, I've yet to meet a single person who enjoyed making the same amount of money as they hated losing the same amount of money, right? For the vast majority of people out there, you'll get less joy from making $1 million than you would from pain from losing $1 million, right?
Twice as much. And when you apply it to the whole market, every single person is feeling that. And that's why things accelerate so quickly to the downside, right? Yeah.
There's real consequences there too. There's possible, if I make $1 million, believe me, I'd be over the moon and there'd be a lot of things I could do. There'd be a lot worse consequences. My life would change more for the negative if I lost that money. So
100%.
Something to think about is the psychology. And I think that plays into the same idea too of why it's hard to buy grinding markets higher, because people don't want to be the one that finally is on the wrong side of that drop. So just another thing to think about.
Your retail traders spend more money trying to stay short, trying to get to the big drop than they'll ever make on the big drop because they don't have the experience to do so. And that's what grinds these markets higher and higher is the weaker hands always looking to short the top. They just get run over. It's when the weaker hands are the last ones to the long when the real risk of this is coming on. And there's, do you find that an open interest? Do you ask people? I think we've talked about before on the grain floor, they used to have the bullish consensus. It was one question: are you bullish grains?
Yeah.
And every time it got to 80% bullish, the high was in. Every time it got to 20% bullish, the low was in. So, it's going to happen when everybody gives up on the shorts and everybody's all into the long side. And that's when these things tend to happen, even if it's not economically created. It's a function of the marketplace. We were talking about, the idea that markets have to come back down. They can't just go one direction all the time. I'm going to give a little context here. In 1987, at the end of the crash, the worst part, the Dow was down 507 points, which was 22%. We've done twice that in a day in the last 2 years, as far as volatility is concerned. As far as percentage of price, because the price is so high, we're going to see some really big moves and when it does happen.
And the one thing that to me makes, and we're not calling for a correction right now.
No.
Correct. We are not.
The one thing that keeps, don't start just getting short and be like, I heard it on YouTube, whether it was us or someone else. Don't do that. Something that feels different about this market for me is that even though everyone's kind of in, it doesn't seem as if people are that bullish in the same way, right? When you look at the .com bubble, there was this euphoria of this brand new technology that people didn't really know what it could do. I mean, like there's a fair case to be made, like the internet would be completely game changing. None of these valuations mean anything anymore. We're going to go to the moon, so to speak. And in 2008, there's a little bit of similar feeling in housing, where not so much that it was just going to go to the moon, but that it couldn't go down. Right now, everyone's in these risk me personally, I don't feel comfortable about any of them. I'm not like all in this market right now. Does anyone have like a feeling besides that?
No, I think what's different right now that has not always been the case. Everyone is skeptic about what's going on. There is still unbelievable concern and fear out there. Normally when the market's going higher, everyone's, you go to the housing bubble, everyone and their mother's buying any house they can and getting all these mortgages and hey, it's going to be a great business and we're going to make millions on this. That's not the mentality I'm personally seeing right now. I'm seeing, a lot of people going, well, hey, I can afford to get in right now, so I'm going to get in. But every news outlet you look at, every person you hear talking, it's coming. It's coming. It's going to be over soon. There's just been this constant skepticism. You got the Fed buying up astronomical amounts. How much of this is going to be real? How many people are ready to just sitting there with their finger on the trigger to hit the sell button?
You just triggered something in my mind there, Dan. Is that our equivalent of the technology in the tech bubble, housing in the housing crisis? Is ours the Fed? Have people become like so at this point that no matter what, I have absolute belief that the Fed will save us?
That just might be it.
Yeah. Ooh, I just thought about that. That's kind of icky. Let's go do something about this.
That might just, you think about it, you looked at it last year, John, we were down 33%. What did we end the year up though? Right. We go down 30+% last year in 2020, a couple months into it. We end the year up 8 to 12%, something like that, if I'm not mistaken.
Yeah, around that. Sounds
something
right.
Like that. So we have from January 1st, 2020 to December 31st, 2020, you ignore the middle and you look at how much your accounts grow. It was a damn good year. I'd be happy making 12% every single year, right? What happened in the middle? The Fed jumped in pretty quickly. Everyone had faith in the Fed. They had faith in the fact that they're going to stimulate these things, get them back going. And maybe that's just the thing. You got the faith in the Fed. I'll ride it out. I'll
Well,
just keep going.
Dan, maybe we'll continue that conversation on the podcast today that we're recording of a similar thing, because I think we're already running a little bit to the long side on here. But is there anything we should address right now as far as questions or otherwise? Or
No, I just want to say hello to Tanya, Federico, Jerry is awake, Greg, Algo Lover. Just want to say hello, everyone.
Is his name Jerry's awake, or is he just said he's awake?
No, Jerry is awake is his name.
Oh, okay. I thought he was just commenting that I'm awake. Well, good for you, Jerry.
Every time I say hi to him, I say Jerry is awake, and I hope I am too.
Yeah, well, that's good. That's all you can ask for every morning.
One thing I want to mention before we part ways with the viewers is when it comes to futures, keeping an eye on open interest too. It's one other tool you can look at when you've seen a market, trending in a certain direction. That open interest gets pretty high. It kind of makes me think about John's story with the grain consensus,
Mhm.
So that's something that could show basically the tip of the hand on a new direction in the marketplace.
That's a good place to end it. But first, Dan, you mentioned your quote earlier. Lay it on us.
Yeah, I do. John Templeton here. I kind of like it. I think it goes a lot with what we've talked about here. Bull markets are born on pessimism, grow on skepticism, mature on optimism, and die on euphoria.
That Templeton guy. Yeah. I guess that's why he made the big bucks.
Yep.
Yeah.
Okay, well, that's all for Coach's Playbook this week. We'll take a final blessing from Hogue here, and then we'll see you next week. We'll be back to hopefully not talk about the correction in progress.
Well, nobody knows when it's going to come. If you've been watching the forecast or the recap, I've had big anxiety about it happening, and that's just telling me that it's probably not going to, at least not yet. So just trade what you see. Take what the market is giving you. We know that the equity markets have kind of trimmed down some of the bigger profits that we've been used to for the last year. Range bound markets do give good opportunities, good risk management levels. Just take your time and try and be in the right seat the right way if something does happen. But we don't know when, we don't know how. Just get out there, trade what you see, and trade well. We'll see you next time.
Sage advice. See you next week, y'all.